Tankers just started moving through the world's most critical oil choke point again, and already Iran is warning it might shut the gate and lock the world outside. If this standoff escalates, your fuel bill, your inflation rate, and even your stock portfolio all get dragged into the crossfire. Right now, we are in a strange, fragile moment. After weeks of naval tension around the Strait of Hormuz, Iran reopened the passage to commercial traffic under a temporary ceasefire. Markets relaxed and oil prices eased. Then, within hours, Iranian lawmakers threatened to require their authorization for ships and hinted the strait could close again if the US keeps its blockade on Iranian ports in place. The US has made it clear the blockade stays until there is a bigger nuclear and peace deal, which means this calm is built on very shaky ground. And because almost a fifth of global oil flows through this narrow waterway, every headline from this region is now a direct story about your cost of living. Here is what is actually happening. The Strait of Hormuz is a 21-mile wide corridor between Iran and the Arabian Peninsula that handles roughly 20% of the world's traded oil. After a series of blockades and naval confrontations tied to the broader Middle East conflict, Iran announced that the strait would be open for the rest of a ceasefire window, so tankers started to move again and the market breathed a little easier. For a brief moment, it looked like we had dodged another energy shock. But then the political messaging flipped, and that is where the story really starts for investors. Within hours, the Speaker of Iran's parliament, Mohammad Bagher Ghalibaf, warned that ships would need Iranian authorization to pass and that the strait could shut again if Washington's blockade on Iranian ports continues. On the other side, the US confirmed that its naval blockade would remain in force until there is a broader deal, not just a temporary ceasefire. So we now have a choke point that is technically open, but politically on notice. Markets are trying to price two very different futures at the same time, one where oil keeps flowing, and another where even a short disruption sends shockwaves. That tug of war is exactly what you are seeing in oil prices, airline stocks, and currency moves. Here is why this is much bigger than a shipping story. When around 20% of global oil trade passes through a single narrow corridor, any serious threat to that corridor becomes an instant tax on the world economy. If tankers are delayed or rerouted, you raise transport costs, tighten supply, and the price of energy climbs. Higher energy prices then feed into almost everything, from the cost of making fertilizer to the cost of flying planes and running factories. That is how a regional naval standoff in a 21-mile strait can show up in your next grocery bill. Mechanically, the chain reaction looks simple, even if the politics behind it are messy. Disruption risk at Hormuz pushes oil prices up, those higher energy costs feed inflation, and that puts central banks back in a corner. If inflation rises again, central banks either keep interest rates higher for longer or raise them further, which slows growth, crushes some borrowers, and can hit housing and equity markets. If they cut too early while energy stays expensive, inflation can stick and erode real wages. So this strait is not just a shipping lane, it is a lever on the balance between growth and price stability in almost every major economy. We are already seeing the first second-order moves. Asian importers are scrambling for alternative routes and supply arrangements to reduce dependence on a single choke point, even if that means paying more in the short term. European travel and airline stocks are swinging as traders try to guess whether fuel costs will stay manageable or spike again. Capital is rotating into US energy names because if supply is threatened and prices climb, producers and shale operators stand to benefit. At the same time, some emerging market currencies are wobbling under the weight of imported inflation and rising energy bills. The tension here is that no one can be sure which narrative will win. On one side, you have cautious optimism that the ceasefire trade is working and that cooler heads will keep the strait open enough to avoid a 2022-style energy shock. On the other, you have real fear that we are one bad incident or one sharp statement away from oil shooting toward levels that would hit consumers hard. Social feeds are full of tanker videos, trader commentary, and a simple question: will this hold? Or are we just waiting for the next escalation? That uncertainty alone is enough to keep volatility in energy markets elevated. For investors and ordinary savers, the payoff is about understanding who wins and who loses if this standoff drags on. Energy producers and US shale operators benefit from sustained higher prices, which can support profits and share prices even as other sectors struggle. Importers and fuel-intensive businesses, such as airlines and parts of manufacturing, face a margin squeeze if they cannot pass higher costs on to consumers. Emerging market stocks and currencies that rely on imported energy become more vulnerable because their central banks have to fight inflation without the same tools or credibility. And investors who hold broad global equity exposure are increasingly hostage to how this single choke point drama plays out. This is where it gets interesting for your own strategy. If closure fears reignite, you tend to see defensive rotations into commodities, gold, and some energy-heavy markets, while growth-sensitive sectors lose favor. If the situation stabilizes and the strait stays reliably open, some of that money can flow back into cyclicals, travel, and emerging markets that look oversold. The problem is that the narrative can flip in a matter of hours, just like it did when Iran moved from reopening to fresh threats in the same news cycle. That is why treating this as a one-time headline is risky. It is an ongoing risk factor you have to monitor. And this brewing energy shock risk is not the only signal flashing on the global dashboard. At almost the same time, the International Monetary Fund cut its 2026 global growth forecast to 3.1% and directly blamed the Middle East war, showing how quickly conflict and energy prices are feeding into the big macro models. Their baseline assumes only moderate energy price spikes, while the more adverse scenarios slash growth closer to 2%, especially for emerging markets and commodity importers. That combination of conflict, energy shocks, and weaker growth is exactly what central banks and investors have been hoping to avoid. Meanwhile, in Washington, a very different kind of money story is starting to unfold. After key tariffs were struck down in court, the US is about to switch on a new CAPE refund portal that lets importers file for billions in tariff refunds plus interest, potentially returning between $127 and $166 billion to corporate balance sheets. That is a quiet but powerful liquidity injection for companies that have been paying elevated costs for years. If even part of that flows into investment or pricing, it can offset some of the inflation pressure coming from the energy side. At the same time, governments in Asia are already moving into crisis management mode. South Korea just announced a multi-billion-dollar stimulus package, including cash assistance for the majority of households and accelerated spending, explicitly to shield its economy from the Iran-related oil shock. The goal is simple: protect domestic demand and show global investors that export-heavy economies will not just sit and wait for central banks to act. These kinds of fiscal moves highlight how quickly a geopolitical flare-up in one strait forces policy changes on the other side of the world. Step back from the headlines, and a bigger pattern comes into focus. Geopolitics, energy, and monetary policy are no longer separate stories. They are now tightly linked parts of the same system shaping your cost of living and your returns. A threat in a 21-mile-wide corridor can rewrite global growth forecasts, trigger emergency stimulus, and drive capital from airlines into oil rigs and gold. If you understand those links, you are less likely to be surprised when the next local conflict suddenly shows up in your portfolio. So as this Strait of Hormuz drama keeps unfolding, the real move is not to panic. It is to watch how energy prices, policy responses, and market rotations evolve together and adjust your risk accordingly.